Hello and welcome to this week's episode of the Scottish Property Podcast. My name is Stephen Clark and joined with always with my co-host Nick Ponte. How you doing, Nick?
I'm good, Stephen. Yeah, delighted to have another guest on the show. This week we've got Jonathan Williams, who's a mortgage broker based in Glasgow. I've known Jonathan for a while, actually. I've used his services before as well. Very good at what he does. We go into, what do we go into?
So we go specifically into the government-backed mortgages and the first-time buyer schemes.
I think it's quite good because it's all very current and it's affecting the property market at the moment, obviously, with the huge demand, and there's going to be a huge influx, I think, from first-time buyers as well, who are able to now get on with just the 5% deposits. I just think as well, you know, if you're young and you're just starting out, then it's a good chance as well to get yourself on the ladder. You know, interest rates have never been so low. You know, with only a 5% deposit, you only need really about £5,000 to get, you know, started with a decent property that potentially could set you up over the next few years to build up some equity, which will in turn give you some money to invest. I mean, that's how I started. When I bought my first property at 19, you know, I only had about £5,000 to start with. That property grew in value, went up 70 grand in the space of 4 years. So, you know, okay, I got in it. Luckily, I was lucky and I got.
You never know, mate. The way the market's going, they might get the same kind of growth right now. So yeah, you're absolutely right. But we do get a lot of messages from first-time buyers and young guys and girls kind of looking to starting property and looking for a bit of advice. And obviously looking at the headlines in the news recently from these government-backed schemes, we thought it'd be nice to do a podcast episode on it. But we did pick holes in it straight from the start, didn't we? So I think it's nice to have the clear view of what you're getting into and what's available and what the downfalls or the pitfalls could be.
Yeah.
Well.
No, that was one of the good things. Jonathan's very honest. You know, he's not just trying to make it all look like it's easy. You know, he shows the pitfalls and how it's expensive as well. You know, because you have to pay extra fees and stuff. And you know, the new government one from after the budget with the, you know, them talking about backing these guaranteed mortgages, there could be higher interest rates and some potential pitfalls there as well. So yeah, we go into all that detail, and yeah, without further ado, should we just cut to the interview?
Yeah, let's do it.
Jonathan Williams of Bricks and Mortar Mortgages, welcome to the Scottish Property Podcast. Delight to have you on the show. How are you?
Good morning, chaps. I am super duper, raring to go. I'm loving your beard, Nick.
It's getting a bit out of control. I'm looking forward to getting out of this lockdown and getting to the barbers.
I tell you, let's hope this afternoon we get a little bit more good news, eh?
Exactly. We've got Stephen Clark here as well. So I don't know if you guys have met before, but
I don't think we've had. Obviously, I've seen you on the socials. So no, good to meet you.
Yeah, not had the pleasure, Jonathan. Thanks very much for joining us today.
No, delighted.
Good stuff. So we're just going to have a little chat regarding, two things specifically that we want to focus on. One being the First Home Buyers Fund that we've got here in Scotland, which is due to come back in April, I think, Jonathan?
1st of April, I've been told.
Okay. And also we want to get on to the new 95% loan-to-value government-backed mortgages as well, which I think would be helpful to have a wee chat and discussion on that as well. So we've got Jonathan here, who's going to give a quick introduction. So just for the listeners, Jonathan, what is it you do yourself? Give a quick introduction.
Yeah, well, my background is in the law. I spent 25, well, maybe 30 years on the coalface of residential conveyancing. And yeah, 92 I started. So back in the day, I've maybe done 6,000 transactions, got really just fed up with that. 2015, I just thought, God, there must be something better out there. And when we were not very busy during the conveyancing side of things, which was generally every February, what I thought, well, is there some way that I can do both mortgages and also conveyancing? Because if I can open something where I'm able to advise both buyers and also people who are wanting finance, and I can just wear two hats, then that would be something that would be, you know, I think would really work. And then March came along, we got busy again, and then I'd forget about it for another year. But then I was working away as a solicitor, and it was just soul destroying what I was doing. I mean, you were just getting no thanks for what you were doing. And I thought, no, that's it. So I decided to leave my legal job, retrained in finance, And after a couple of years, opened up bricks and mortar mortgages. And people say, listen, you must have had a really good career as a solicitor, you made a bit of money, etc. Why the hell do you want to, throw that away and do what you're doing? And I said, well, I've got to a stage now where I've been lucky enough to invest in property. I've got half a dozen buy-to-lets. And so I thought I want to do something that I actually enjoy and feel as if I'm helping people. And the first 6 weeks, I knew exactly I'd made the right decision, because there were more people in that 6 weeks that had thanked me for getting them a mortgage than had thanked me for getting a set of keys to them as a solicitor in 10 years. And I thought, and it wasn't that difficult. I mean, I was, for the people I was acting for, it was as if I was pulling a rabbit out of the hat. But it was just purely because they didn't know how to get a mortgage, that they just thought that I was a genius.
Good stuff. So I just want to say that if anybody lives in Glasgow, right, and you're driving down, is it Crow Road, your office? Crow Road in Glasgow, you get to the kind of Jordan Hill bit where the shops are.
Yeah.
Jonathan's got a brightly coloured pink shop front there. Just at the kind of traffic lights. And if you look to your left as you're going towards the Clyde Tunnel, you'll usually see him standing at the back of the office at his desk. He's always standing, and you've got a bit of a reputation around there locally now, haven't you?
Well, I'll tell you a little story about that. My daughter is now up in Aberdeen and she plays hockey. And one of the pals she plays hockey with was at the school, Jordan Hill School. And of course, they're talking about their parents. What do your parents do? And this girl said, what did your dad do? And she said, oh, he runs a mortgage shop, bricks and mortar mortgage at Jordan Hill. And without a word of a lie, the girl turns around and says, that's the standing guy. That's the guy who stands at his desk. So apparently in Jordan Hill, I'm not known for mortgages. I'm just known as the guy who stands at a desk.
Can you not afford any office chairs, man? All these mortgages you're putting through. You must be able to at least give the staff a seat to sit on. Do you know what I mean?
No, listen, I'm the only one who stands. I love it. I love it, I have to say. I thought when I started doing it, after a day, 7-8 hours, whatever, standing on your haunches, you'd be absolutely knackered. But no, it's energizing. No, listen, if nobody's done it, just have a go at it. It's good.
Good stuff. Right, let's get into business then. So we're specifically looking at, well, let's start with the First Home Buyers Fund. Now, the reason we kind of want to bring this up in the podcast, I mean, most of our listeners are investors, right? Buy to let, they want to do flips and all the rest of it. But there is quite a lot of people that contact us week in, week out through Instagram or whatever that are, younger people who are just trying to get their foot in the door into property. Yeah. Now, you could argue that there's probably not been any better time to actually, buy a property as a first-time buyer. I mean, interest rates are low. You've got all these schemes that are coming out for the government. Okay, the market is hard, in terms of shortage of stock and all that. Mm-hmm. But let's go back to basics and just talk about this First Home Buyers Fund and how people can get access to that. If you just want to give a description about it.
Yeah, so let's start off. £25,000, that's the maximum amount that you're going to be able to get from the government. You have to be a first-time buyer and you have to be looking at a mortgage, and it has to be your main residence. So those who are thinking, listen, that's great, I'll be able to get a 5% mortgage or 95% mortgage, and not bother to reside in the property and rent it out. That's just not going to happen. So you've got to use it as your main residence. You can buy a property jointly, and this is one of the tweaks. You can buy a property jointly, and at least one of you has to be a first-time buyer. And at the end of the day, when you're actually picking up the keys, if your partner has still owned the property, they have to sell the property. Okay, so you can be buying the property with somebody who already owns the property, but they have to be in the process of selling it. So at the end of the day, when you move into the new property, you don't have the second property. It's all about the government making sure that if you're going to access these funds, that at the end of the day, you're only going to have one property.
Okay.
So you have to work out whether or not it's going to be affordable. So there's a calculator that you can use and go on to the government website. That's really important. You can't actually apply for the First Home Fund until you've had an offer accepted. Okay.
Interesting.
So, so you need to make sure that you are going to be able to get the first home fund. You put your offer in, your offer then gets accepted, and then you make your application to the first home fund. Now,
Would the first step be to come and speak to a broker then, like yourself, to see if you could qualify for it then?
Yeah, but you can do it online. I mean, you can just go onto the website, the government website, and it's a dead easy Excel spreadsheet.
Right.
If people wanted me to send them the Excel spreadsheet, happy to do that. But you can go online, and then it's just a case of putting in your numbers, what you earn, what your outgoings are, how much of a deposit you've got, and then it's dead easy because it flags up green or red. And if you've got reds, then you're not eligible. And if it's all green, then you're eligible. So you get your offer.
Is this a loan or a grant by the government?
So you're going to have to pay it back, but you
Right.
don't have to pay any interest on it.
All right.
I'll tell you now, I'm not a big fan of it, and there are reasons why I'm not a big fan of it. And I have to say that there's some people who come to me and they say, listen, I've got 5%, but I could probably get to 10%. And my view is very much, if you can get to 10%, then go down that route, because it's clunky, it's expensive, and at the end of the day, you're going to end up having to pay the money back. But listen, we'll come.
Do you pay it back in monthly tranches, or do you just pay it back once you sell the property?
Yeah, so when you sell the property, there's no requirement for you to repay it back until you sell the property.
Right.
So if you take the way that they work out how you pay it back is that when they give you the money, they work out what percentage that is of the home report value. So if you buy a property £100,000 and you take the full £25,000, then they're giving you 25%. So that when you come to sell the property, you have to give them back 25%. So if your property goes up in value to £200,000, for argument's sake, you end up having to pay them back £50,000.
So they're making 50% of your profits basically as well.
It's almost like a joint venture. Do you know what I mean?
The government. So when you say it's an interest-free loan, the government's still making their money.
Oh, absolutely.
On the property prices. What happens if it goes the other way then, and the property devalues by the time you sell it? Do they still get their exact sum, or do they still get 25% off what you sold?
They'll get 25%, but you cannot sell the property without their approval. If you cannot sell the property for less than 95% of its value without their approval.
This is good. We're already picking holes in this, and this is what I like to do.
There's lots of holes. There's lots of holes to be picked.
No, this is good. Let's just carry on. So this is the problem. They own a stake. Basically, they're on a share in the property. So, like you say, if it goes up in value, then that's where they're going to be.
The other thing they've been very canny about is that in this rising market, let's take the example of a property home reported at £100,000. They will then take a stake of, say, £25,000. So that's a 25% stake. But if you buy the property, for argument's sake, at £125,000, and you take their stake of £25,000, you'd be thinking, well, surely their stake then is 25,000 as against £125,000, i.e. 20%. No, that's not what it works out as. So the 25,000 in their stake is based upon the home report value and not upon the purchase price.
Right, okay.
So that's difficult in this.
Yeah. So if you've overpaid for the property, which most people will be overpaying right now, the market's so hot, then another hole.
Another thing that I wanted to ask you, we're looking at how potentially young people could get their foot in the ladder here in the property. I mean, my first property actually was the one that I made the most money on, right? It was just timing. I was lucky. Yeah. And I held it for 4 years. As a young guy, I think I was 19 when I bought it. I sold it 4 years later and made £70,000 profit, right?
The big problem that I see is that it's aimed at first-time buyers. And the concern that I always have is that ultimately that's not going to be your forever property. And it's just the stepping stone for you to go up the property food chain. So if you end up at the end of the day having to pay back 25% of your profit to the government, then you're going to end up potentially having to stay in the property for longer. So I always advise my clients that if you're going to take this, treat it as a second mortgage, and as best as you can, pay back. So what you can do is you can pay back in 5% tranches to reduce the percentage that the government have. And I think if you do that, then you're going to be in a situation where you're not going to be staying in the property for longer than you think.
Right. Okay. So
Have you paid that back over before you sold it? Are you
Yes.
still in a contract to the government that they still get a share of what the uplift in the value is in?
So what will happen is that you will then go to the government, say you want to pay 5% back. The government will then say, well, that's fine. We'll value the property now. So they will get their money back based upon that valuation at that time. So if there has been an uplift, then they'll get more back.
At the government's cost, or
No,
at the owner's cost, or the
don't be
government's
silly.
cost?
Don't be silly. You'll have to pay the costs. You'll have to pay for the valuation, and you'll probably have to pay for their solicitors. And that's my other thing. It's expensive. It's expensive and it's clunky because you've got to pay 550 quid to join. Okay. You get that back if you don't get the first home fund. But the solicitors, you want to see the amount of paper that this creates. I mean, for every transaction, they must have chopped down at least 2 or 3 trees. I mean, the amount of paperwork is just, and I can understand why there's additional paperwork. So you've got the solicitor then who's going to have to trawl through all that additional paperwork. The government have appointed, I think it's Harper McLeod, to look after their end. So you've now got 3 solicitors in the transaction. You've got your purchaser, your seller, and your home fund. And as you boys know, as soon as you start getting solicitors involved, A,
takes hell longer.
More expensive, and B, it's more expensive.
So we've picked out a lot of holes and there's disadvantages there. Like what the advantages, obviously people can get started with only 5%. Is there any other benefits?
I mean, I think it's great that if you don't have 2 halfpennies to rub together and you've only got 5%, then it's fantastic. But I mean, my view is that it's expensive, and it's probably, to me anyway, it's the last chance saloon. If you're absolutely adamant that you want to get on the property market now, then it's absolutely great.
And you raised a really good point there, which, it amazes me how, still so many people don't realise that when they're bidding at the moment in this hot market and they're getting over and above the home report, they think they're going to get lending on that. That's a real point. People, especially now, need to know that you won't, over and above the home report, that has to come out your own pocket.
You can't borrow that. You're absolutely correct. And the amount of times where there's this pregnant pause when I'm talking to clients and it's clear that they haven't actually understood that.
Yeah. Right. So talking about the 5%, which brings us on kind of nicely, if we move away from the First Home Buyers Fund, which is the Scottish kind of government kind of scheme for first time buyers, let's roll on to the next thing that we want to talk about, which has come out sort of post-budget. So basically, you go ahead.
So my main concern was is that if the Scottish government have got a scheme, my main concern was, is this actually going to come up north? Are we going to get the 5%? And I do think that we are going to get that. It's very embryonic.
Just before we go on to that. So this is basically the government have announced just after the last budget that they will back mortgages up to 95% loan to value. Now, this is important because just before the pandemic, there was quite a few 95% LTV mortgages, but then what happened was a lot of the lenders basically pulled them and stopped doing them, right? Yeah. So then the government have come back and says, right, we'll guarantee the 5% deposits, basically, just to kind of put people in the picture.
Yeah. So my concern was that, well, Scotland have got their own 5% deal, as it were. And what with, I suppose, Boris being Boris and wanting to make sure that the union stays the union, I'm sure that it will come up. And we've heard from Halifax, and Halifax are working in the background. I have to say, I've not heard from any other lenders. So as a mortgage broker, we generally have conversations with business development managers within all of the lenders, and Halifax are the only ones who've actually come out and said, listen, we are working on this, give us some time, but it's certainly going to happen. I'm sure that it will happen, but as I say, we've only heard from Halifax. So the idea is that you will be able to put down a 5% deposit, okay? And ultimately, if the property gets repossessed and the bank lose money, then the government are going to guarantee that they'll pay up to 95% of the value of the property. So, as I say, it's a very early stage. I don't know how much extra paperwork is going to be involved. What I'm hoping is that there's not going to be any additional paperwork, and that the government will be speaking to the individual lenders and they will have blanket agreements, because what we want is we want to make sure that the whole thing is as simple and as straightforward as possible. Mm-hmm. And I think that if it is straightforward and possible, I think, well, what's the point in doing the first home fund?
It basically,
doesn't make any sense.
Wipes it out because, like you say, the good thing about this one would be that the government won't hold an equity share or a stake in the property. So you're kind of, it's much better that way.
The caveat that I would have is that criteria. I think it sounds great, 5%, and everybody will be thinking, listen, let's pile in. And the additional benefit is that it's not just first-time buyers.
Yeah.
The 5% is going to help everybody. But the concern is going to be, I think that the lenders will be very much cherry picking here. I think that you will have to be so squeaky clean as far as your credit file is concerned. And they'll just say, listen, no, because Tom, Dick and Harry will come into this. I mean, everybody will be piling into this. And so what tends to happen is that the lenders, as soon as they start getting overworked, they say, well, listen, well, we don't like you, and they'll put criteria out there. Yeah. I would be surprised if they will allow flats, I have to say.
And like you say, it's getting a bit close to the 2007 days of like Northern Rock, 100%, and self-certified mortgages and all the rest of it. Yeah. You know what I mean? So they will be a bit wary. But have you heard anything about rates, like interest rates or anything like that? Because some people say that they're going to be expecting them to be a lot higher.
So you're looking at 90% rates at the moment are sort of threes, high, sort of 3.3, I think, Nationwide Building Society. 3.3 Nationwide Building Society for a good 90%. So I wouldn't be surprised if it was high threes, possibly nudging into a 4%. I think it will be expensive borrowing.
Yeah.
Based upon what the base rate is.
It'll be interesting to see what happens. The other thing that I think, obviously, like you said about the kind of criteria, and people get carried away with the headlines because they said that they would it'd be up to, what is it, 600 grand or something like that, but obviously people see the 600 grand, they think, oh, I can go for a property at 600 grand, but obviously they need to realize that it is all down to your income and what you can actually afford.
No, absolutely.
I think it's really topical at the moment, obviously, all these kind of schemes and things, and what effect that might have on the market. And we just think for our younger audience who are just trying to get in there, that if you only need to find 5%, and it is a good chance to get started, even if it's with your first residential, just get in there. And over the next couple of years, you just don't know, things could rocket and you could build up some equity then to later on down the line to invest in buy to let,
My heart goes out to the kids who are looking to get onto the property ladder, because the market at the moment is just absolutely horrendous as far as, first-time buyers are concerned. It's so difficult to buy something at or around home report value. Just that there is an issue at the moment with regards to demand. There's just too much demand and there's just not enough stock out there.
Give us some examples then, because I've heard you talk about on your podcast,
there's some nut stuff. I mean, I spoke to an estate agent last week, Scotstoun. Okay, so Scotstoun, a lot of people buy in Scotstoun because it's potentially within the catchment area of Jordan Hill School. So Lennox Avenue, Home Report 385, End Terrace apparently needs a bit of work. 105,000 over Home Report value it went for. And it's not even in the catchment area.
That's nuts. That's insane. Do you think the supply will increase with the kids now going back to school and maybe people now going to attempt to put the houses on the market?
No, I think so. The reason why there are too many people in the market are, I guess, fourfold. There was the stamp duty, which is now gone, but that's now going to be replaced by the 5% crowd who come in. And
by the way, do you think that had a big impact? Like, you know, did it do a job? Did it really drive the market?
No, we didn't need it. It was not needed.
Yeah.
What they should have done was they should have held back, because what's happened is that you've got your employer saying to your employees, listen, you better get used to working from your kitchen, because we're not going to see you again. You better get used to that. And so people are saying, well, listen, I don't really want to work in my kitchen nor my bedroom. Let's buy another property with an extra room. You then got the garden club who said, well, listen, I don't like living in a flat. I've been cooped up for lockdown. I need to get a little bit of garden space. Let's go and buy something out in the sticks somewhere. You then got your stamp duty people who were obviously making, or it was cheaper to buy stuff because they weren't having to pay the stamp duty. But the big kicker is that nobody has been able to spend any of their money for 12 months. They can't go on holiday. And so what they're doing is they're either doing their property up, or they're building an extension, or they're buying a new place. And so that's why the market is the market at the moment. Those four, but there's so much money floating about that people are just piling in because they've not been able to go on holiday, not been able to spend their money. So, and all the banks will tell you that their savings have rocketed, absolutely rocketed over the last 12 months. And it's just going into property. But so that's the reason why there's so many people who are in the market. But the problem is there's no stock. And there's no stock because of two things. There's no stock, I think, because if you're going up the property food chain, you want to feel confident that your job is going to be safe. And that bleeds into then the economy. And if you've got concerns about the economy, it's probably deep down everybody else has, because really we don't know what's going to be happening once we come out of lockdown. How many properties, how many businesses are going to go bust? How many people are going to be made unemployed? And so therefore, there must be a reticence of people who are thinking, you know what, because it is a gamble going up the property food chain, because you've got a higher mortgage, you know, there's more to lose. And I think people are concerned about that. And so if people are concerned about that, they're not putting their properties on the market. And so therefore, there's not enough stock out there.
The only thing that I would say is that I think once it starts filtering through, you know, that property prices are on the rise and the kind of, you know, headlines and that start appearing in the papers, then people start then thinking, well, hopefully, you know, they'll think this is a good time, you know, let's cash in, you know, then you'll start getting more properties on.
So that's fine. I agree with that. But then you've got the stamp duty issue. We're paying too much stamp duty. The government, in their infinite wisdom, didn't speak to the property professionals, and they're absolutely crucifying people for stamp duty. Because what I think they should have done is that they should have. What is happening at the top end of the market is that people aren't moving because they don't want to pay 20, 30, 40,000 pounds in stamp duty. They'd rather pay it to their architect and their local builder and build in their garden to do an extension. So they don't move. And so therefore that means that there's no tax revenue coming into the government. And worse of all is that there's no movement up there at the top end. And if you don't have movement at the top end, you don't have movement at the bottom end. So what they should be thinking about doing is reducing the rate, or having just a whole look at the stamp duty side of things, so that they could end up making more tax revenue. But
there was serious. I think there was some serious talk. I read somewhere in some of the papers that they were really thinking about doing that down in England, but I don't know about Scotland. Do you know what I mean? It's like we always seem to go one step further with the, you know, like they've got 3% on their additional dwelling supplement, we've got 4%. Do you know what I mean?
Don't go there, please.
Anyway,
that could go somewhere where we don't want to go.
That starts getting a bit political. But so the impact then on the market in terms of these schemes that we've talked about. So already, you know, like as an investor myself, I'm looking at properties, you know, up to about 100,000, you know, 1-2 bedroom flats, you know, round about the kind of periphery, the city centre and stuff like that. And obviously, you know, you are competing with first time buyers and the like. So is that just going to make the competition tougher then? Do you see a lot more first time buyers and people?
It has to happen. Well, it has to happen because there'll be those, and we've spoken to them that, you know, I've only got 5%. I've only got 5%. I said, well, you can't really do anything unless you go for the first home fund. I explain the first home fund, and they say, well, you know, maybe not. So I think you're just going to get a whole flux of 5%ers coming into the market, chasing properties that just are non-existent.
And then you kind of think to yourself, well, you know, if things do go nuts again, like out of lockdown, and things start spiraling out of control in terms of, you know, values like going mental and people overpaying, then you could think, you know, a few years down the line when maybe they need to start raising interest rates and all the rest of it, what sort of state are we going to be in then? Do you know what I mean?
But we're already seeing this from the day that they unlocked us back in July or August of last year. There has been a sustained market that nobody in property over the last 30 years has seen. It's been astronomical. I speak to estate agents on a day-to-day basis, and they can't believe it.
Did you see the BBC headline a couple of days ago on the BBC News website? It said the biggest housing slump or something like that.
but that is the case, because there's not enough property that's coming onto the market, and what's happening is that's then just creating this spike.
Yeah. So you said in your podcast that you've never been busier. So obviously this is buyers.
But again, you're busier, but it's great being busy because you've got lots of people wanting to buy, but your conversion rate is so small because you're having to
There's nothing to buy.
You can't buy anything, and you're putting 15-20% over the home report value, and you know deep down that you haven't got an earthly.
So you think
so decision in principles, but no actual full applications.
Yeah. I mean, so my pipeline is fantastic. I just need to try and convert it, and I'm not going to be able to convert it until, you know, we get more stock onto the market.
So you think one of the things to kind of unlocking this is to revise the whole kind of LBTT stamp duty kind of system, I feel like?
I think underlying what we need to do is we need to get more stock on, okay?
Aye.
And one of the things I think which is within our control is the LBTT. You know, the economy's not within our control, but the LBTT is. So I guess, yes. I mean, to have a look at that just to see how they could potentially unlock the property market. You know, you talk to any professionals in the property game, and they'll say exactly the same.
Yeah, no, it's really interesting. And then, you know, do you not think naturally as we come out of lockdown and consumer confidence gets better on that, then obviously there's going to be more stock coming on the market? Like, do you not see that as a...
I do think that it will... Confidence drives the market. There's no doubt about that. And ultimately, the economy will be that big. You know, that's what everybody is looking at. And if everybody feels confident that their jobs are safe, then of course they're going to feel better about putting their properties on the market. Yeah. But ultimately, until they look at the LBTT issue, then, you know, we've had this issue about unlocking the market for 3 or 4 years. As soon as they changed the stamp duty thresholds years ago, the estate agents, they were the first to come out and say, well, listen, you know, we are so much more expensive than down in England. As soon as you start, if you buy a property, I know this is at the high end of stuff. If you buy a property at £385,000, if you buy a property for anything higher than £385,000, you are paying double the stamp duty up here than you are down south.
See where the market's on that.
And the problem is going to be is that if we're in this spiky market and people are paying so much more over the home report value, we're going to get closer and closer and closer to the, you know, the average house price is going to go up. We're going to get to buy a half decent property, you are going to have to pay, you know, a decent sandstone property, you are going to have to pay 400, 500,000 pounds. So everybody's being dragged into that.
Yeah, absolutely.
And I think, I honestly deep down think that sometimes the government think that if you can afford a property at 500,000 pounds, you can afford 15 grand in stamp duty. I've yet to meet a person who has got 15 grand in their bank and can afford a five. It's not, I mean, every pound's a prisoner when you're buying and selling a property.
Oh yeah, I mean, we just moved last year, like just during lockdown actually, and I think our tax bill for the move was about 9 grand, I think it was, which was sore because like
Painful,
you're like, imagine what you can do with that money. Do you know what I mean? Like you're like, ah. So
we all have to pay something, but I think I think there would have been a better way of doing it to create more income, and ultimately it has to be an income generator for the government. And they will generate more income by selling more properties.
More transactions.
I definitely don't think they're going to put, you know, from the going back to investors and buy to let investors and all, I definitely don't think they'll do anything with that. If anything, they'll probably rise that. But how are you? I mean, you organise, you know, you deal with buy to let investors as well, and you do a lot of buy to let mortgages and stuff like that. Are you, you know, how are you finding that market in terms of the lending and stuff? Are things okay there? People getting the buy-to-let mortgages?
Yeah, I mean, as I say to everybody, and still people come to me not with a full understanding of buy-to-let, and I've put various things out in social as far as just trying to get a better understanding, just the rudiments of buy-to-let. It's nothing to do with your income. It's all to do with the rental income. And as long as you've got the rental income, then you're pretty much home and hosed, and you've got a decent credit report, obviously. I mean, that's a given. You're pretty much home and hosed. The rates at the moment, Santander 2.34 for an individual buy-to-let. The limited company buy-to-let still more expensive. You've got to think long and hard. I mean, really, it's the first conversation I have with all of my clients. I say, what's your goal? What are you trying to achieve out of this? Because if they've understood their goals and they've got goals in place, then all the professionals can help them. The property sourcers, the mortgage people, the solicitors, the accountants, you know, they can give them the best advice as long as they've got their goals sorted out. But so many people just come to me and they don't really know why. A lot of people are doing it for the pension play. I have to say that's generally what we will do. We don't generally deal with the flip kind of market. So generally it's those who are seeing the benefit of a pension play, a long-term pension play, and building up a portfolio of, you know, 3 or 4 properties. But the tax is a big issue, because you need to decide very early on as to whether or not you're going down this as an individual or whether you're going down it as a limited company.
Yeah, definitely need to get the structure. And like you said right at the start there, you know, going into it with the reason why are you doing it? We talk about it all the time, like it's so important. You know, don't just go in thinking you're going to make loads of money in this property game, because you're going to get a sad shock quite early on.
And that it's going to be a breeze.
Yeah.
I love this phrase, passive income. There's nothing passive about it. It's bloody hard work.
You get the right team in place, and then it's passive as it can be.
Well, it's yes. You've got to get the right team in place. There's no doubt about that.
Good stuff. Is there anything else you want to add? I mean, obviously people can come and see you, Jonathan, if they want to look into getting mortgages. Yeah,
no, absolutely. Delighted to have a chat with them. You know, first conversation, you know, it's always important to have that first conversation. We know we might not be the best fit for them, but certainly I think from a buy-to-let perspective, we tick a lot of boxes. So I've got my legal hat on there, done lots and lots. There's not much I don't know about the legal process. That then spirals into, I've got half a dozen buy-to-lets myself. So, you know, I can empathize with the clients. I know what they're trying to do. And obviously we're whole of market. So we're going to be able to get the best deal for them. In fact, one of my clients said to me, "Oh, that's absolutely fantastic. You tick all these boxes. You're like the Swiss Army knife of property." And I thought, well, that's brilliant. I'm taking that and I'm going to use that. In fact, I've got a banner. I'm going to put a banner on the railings at Jordan Hill. And I've got them. They're sitting in the office. He's the Swiss Army knife of property.
That's brilliant. You don't make your clients stand at your desk if they come for a meeting, do
Some
you?
of them like to.